Welcome to this video on common position sizing performance measures. The goal of the position sizing techniques is to find the size of trades that will allow the trading system to perform optimally. The size of trades is such that the trading account grows fast enough, and simultaneously, the risk of negative outcomes and higher drawdowns than necessary is minimized. But to set up position sizing correctly, we first need to measure the performance characteristics of our trading system. And we must know what we want to measure, and why we measure it. The trade size is the most common measure related to trading. It determines the trader's exposure to profit or loss. The main goal of money management is to determine the correct size of each trade. Trade size can be measured in dollars, euros, or it can be stated as a percent of the overall portfolio. The next information to look at is to assess the trading system's quality is the percentage of the winning trades compared to the percentage of the losing trades, or win-loss ratio. The next measure is trading system expectancy. It is calculated as the probability of a win, or percentage of winning trades, multiplied by the average win, and subtracting the result from the probability of loss, or percentage of losing trades, multiplied by the average loss. But it's very important to distinguish between the win-loss ratio of winning to losing trades, and trading system expectancy. A lot of beginner traders look for systems with high win-loss ratios, or a high percentage of winning trades. It's psychologically comfortable to have 80% of trades winners. But if the average win is very small, and the average loss is very high, the trading system can still be unprofitable, even though the percentage of the winners is very high. So win-loss ratio, or percentage of winning trades, is just one piece of the puzzle. This ratio depends on the type of trading strategy. Let's have an example of two profitable strategies. Arbitrage strategies tend to have a high percentage of winning trades, but their losing trades are usually much bigger than winning trades. On the other hand, trend-following strategies tend to have a lot of losing trades and a few big winners. Both strategies can be profitable. Having a trading system with a percentage of winning trades larger than 50% does not mean that we have a profitable trading system. Also, having a trading system with an average win-to-loss ratio larger than 1 is not a guaranteed success if the losing trades are prevalent. The very pleasant situation is, if we have a system with prevalent winning trades and average wins larger than average losses, that's the goal. To summarize, in this video, we have covered 5 important position sizing performance measures.